fact that we've had abundant growth, benign inflation and abundant liquidity for all of but the last sort of 6 months, call it, has led investors largely maybe to become overconfident in some of the more passive oriented 60/40 portfolios, which have been caught somewhat flat-footed over the last 6 months. Now, there's a price for taking thoughtful diversification, because you will have tracking error from benchmarks that are widely adopted at times, and it's going to feel like you're doing something very different than your friends. But in our opinion, if one considers the true long-term nature of an investment cycle, i.e., it's not 5 years, it's 20 years, it's 30 years. When you think about even someone who's retiring today at 65, they're still likely to have a 20-year time frame where they're going to have to navigate periods like we're showing on this chart, where you have periods like 1960 to 1980, where the real return on a stock bond portfolio was negative. And I think that in of itself, understanding how real returns function and how they impact assets that are designed for funding liabilities, that is an edge, actually. No one wants to talk about things in that regard. There's not a lot of real return discussions. Most folks are stuck in nominal land. There's a real challenge to that, though. And as you can see in the chart, that 1965 to 1981 period was devastating for assets that were just in the sort of growth type assets, the 60/40. Now, by adding thoughtful allocations to commodities, to those assets that structurally respond well in inflationary impulses, you have a much more robust path. You're driving a 4x4 to work every day, and in the winter you get to work, and in the summer you get to work.
Yeah, I think this chart is one of my favorite charts, and what this really summarizes is the cyclical nature of markets, and the fact that inflation and growth will also dictate liquidity, and liquidity, as we have seen and has been very vivid for the last 10 years, will drive asset prices and can drive asset prices in somewhat crazy directions at times. So recency bias has created beta in the minds of most investors as being equity beta. And as rates went down all the way down to zero, what was once a 60/40 became equities and cash, because no one could hold bonds in their minds, and they couldn't really understand that holding equities was equally as dangerous because of the environment that they were in. So this idea of taking a step back and taking a slightly broader term look at history and understanding that 60/40 doesn't get you all the way there.